Global growth has peaked. That's been clear for a while. It's not unexpected. In fact, we had been expecting for some time that growth would slow from what had been pretty high levels. So the fact that we are anticipating a slowdown in growth in 2019 relative to 2018, to our mind, is perfectly normal. The question is growth going to slow too much? And that's where you have this intersection with financial markets. Equity markets have been, over the last few weeks now, really concerned about the growth outlook and whether or not what we're seeing is indicative of the normal slowing in growth or something that's more dramatic, as seems to be embedded by equity prices currently. Canada, like the U.S., is at the tail end of what's been a fairly long expansion. So the Bank of Canada has been raising rates to slow growth. We see that happening, and we expect that will continue to happen in 2019. What's happened, though, towards the tail end of 2018 has been that oil prices and financial market volatility really picked up. Being a commodity exporter as we are, oil prices are tremendously important to us. So when oil prices fall, that means Canada's weaker. But you're still looking, bottom line, at pretty significant growth, 2%, roughly speaking. And that's roughly in line with the economy's potential. So there's nothing to sneeze about. It's actually pretty decent growth. So the Bank of Canada has been raising rates for a while. It's been raising rates, growth has been reasonably strong, and it wants the economy to slow. We're definitely the most aggressive Canadian bank in terms of forecasting interest rates. We anticipate they end at 2.75. That's 100 basis points from where they are. Other banks have rates ending at 2.25 sometime in 2019 or possibly early 2020. So why are we so much more aggressive in our rate call than other banks? But we have a model-based forecast that uses a lot of the technology the Bank of Canada uses. So as we look at inflation trends, as we look at growth trends, as you look at the labor market, for instance, we think more tightening is required to keep inflation at 2%, which is ultimately the Bank of Canada's mandate. There are risks out there that are significant and they're material, and they're not the function of where you stand in the cycle. And the number one risk from our perspective on that front is what's happening between the U.S. and China on the trade side. Think about it this way. China and the U.S. are the number one, number two economies in the world. Together, they account for 30% of global GDP. If those countries go at each other, it's bad for everybody. Because the stakes are so high, an amplification of the trade war is going to hurt the U.S., it's going to hurt China. There's no question about that. So the issue from a negotiating perspective, in some sense, is who can tolerate the most pain. It's not clear who can do that, but it's clear that both countries have an incentive to minimize the amount of pain that they're currently suffering, and certainly not to exacerbate the pain that they are suffering now.